In these notes and videos, we always talk about the importance of maintaining a long-term focus and executing on a long-term plan. And oftentimes clients will see trades in their account and it may seem like we are trying to time the market, which we're really not trying to do. So I wanted to first lay out the framework for our guiding principles around investments and then explain how we reconcile those with the trades that you'll be seeing in your account. So first and foremost, the first one is we are always going to be plus or minus 5% from our desired equity allocation. So if we're looking at your account and our plan that we agree upon says that you should only be 20% in equities because your goals are such that those accomplish what you need to do and your risk tolerance is such that we cannot afford an equity allocation greater than 20%, we're always going to be plus or minus 20% in the equity markets. When things look really scary, we're not going to shrink that equity portion down to zero. And when things look really promising, we're not going to increase that up to 100%. The reason is because ultimately, as soon as everything looks like it's a great time to invest, planes hit towers, collapses happen, and you get whacked, and then you sell, and you've just shot yourself in the foot. So again, we are always going to be within a small percentage of our desired allocation. From a U.S. versus international perspective, we're always going to be overweight U.S. relative to international markets, roughly 2/3 to 1/3 international. We're going to maintain more specific exposures on the U.S. side. So we may have overweight technology, or overweight value, or overweight momentum at any given point in time, but these will be incremental shifts attempting to add value to the portfolio. From a performance perspective, when we're looking at our model, we are not going to make such massive shifts that we're going to be, we're going to beat our index by 1,000 basis points or underperform our index by 1,000 basis points. Our goal is generally to be plus or minus 300 basis points from our model in terms of managing risk. So again, you will never see us go all in on a specific sector or all in on the equity markets as opposed to, and then getting all out. Fixed income. This is important because a lot of times clients will look at it and goes, okay, why don't I just buy a bond for a set amount of time and call it a day? Well, even if we have a portfolio that says it's going to be 40% in bonds, we want that bond portion to be tactical. So if you see us trading your account, shifting from one kind of bond into another, we're still maintaining that 40% allocation of bonds, but we may tweak your duration. The yield curve may change and longer bonds may be more attractive than shorter bonds and vice versa. We may tweak the credit where we want to go into more corporate bonds or higher yielding bonds versus treasuries. Mortgage bonds may be more attractive. So there's different times that we'll tweak the duration and the credit inside the fixed income portfolio. But again, we're not going to say, well, today we're 40% fixed income, tomorrow we're 80%. It's going to be incremental shifts with inside that allocation. Trades 4 to 6 times a year. So from those rebalancing trades, you will see trades happen 4 to 6 times a year, with most often those rebalancings happen quarterly. Occasionally in years of elections or years like 2000, we had COVID and the market went down 30% in 30 days and then rebounded to had its best 54-day run. Significant market shifts like that can require intra-quarter rebalancings, but typically we're looking at rebalancing 4 times a year. When you see trades in between that time period, we are going to allocate cash as it comes in, as it becomes available. So let's say that cash comes into your account from dividends and interests, or you deposit money. Those trades will happen more frequently, and we will use that cash to rebalance the account. Similarly, in a year like last year, when the bond market and the stock markets were going down, we were more frequently doing tax loss harvesting trades. And again, these are not active trades. We may go from one position to another to recognize those losses for tax purposes, but the general portfolio and the risk parameters of the portfolio are going to remain relatively unchanged. And finally, our final guiding principle is to keep an eye on expenses. Expenses matter, and so we're generally making we're making a point to use the lower cost index funds, or in the case of direct indexing, avoiding ETFs, but focusing on keeping the underlying costs of those funds down, because that is money that goes straight to the investor's bottom line. So when we're looking at our portfolios, again, this goes to the first point. First, we had our guiding principles. Now we're looking at how do we construct these portfolios in conjunction with BlackRock. We start with a long-term strategy. Basically, we have a general philosophy of stocks and bonds that we're taking a long-term approach. Then we adapt to changing macroeconomic conditions. So again, we're not looking at making sea changes based on short-term noise, but there are occasions when things need to shift. For example, last year you would have seen, well, we'll go on that next slide. But then also in selecting the appropriate investment vehicles, whether you're using individual stocks, individual bonds, ETFs, mutual funds, etc. Basically, we're starting with our strategy. We have small tweaks based on conditions, and then we're just selecting the most appropriate vehicles to get those desired allocations. In practice, what this looks like is something like this. So when we're looking over here, this orange to red column is our equities. So it looks like there's more movement along the way, but there really is a very small shift between where we start on the equity side and where we finish on the equity side. Because again, in this scenario where we're a 60% equity allocation, we're always going to be plus or minus 5% of that 60% target. You will see that over time, here in July, we've begun reducing inflation-oriented hedges and bringing stocks down to benchmark. These are small shifts. In your portfolio, it looks like a lot of trades, but essentially what we're doing is making small incremental shifts to fine-tune the portfolio based on change in the market. We are not trying to time the market perfectly. We are trying to make shifts that are incremental based on macroeconomic conditions as our model managers, BlackRock, sees them. This yellow section down here is our fixed income. Again, it looks like we're making significant changes, but we're really not. If you have a 40% equity or fixed income exposure, that is going to be plus or minus that 40%, but we will shift where we may get overweight treasuries, underweight treasuries, lengthen the duration or shorten duration. So you'll see here, interquarter trade to lean more heavily into inflation-resistant themes and introduce commodities back in 2021 as interest rates started to climb. So again, you will see small incremental change in the portfolio, but this is not making sea changes. We're not hoping or desiring or making any efforts to claim that we are going to be all in the stock market when it's going up and all out when it's going down, because we fundamentally believe that we can't do that, nor can anyone else successfully on an ongoing long-term basis. So instead, this is how we manage the portfolio. So again, I hope this helps give you a framework, an idea of how we manage our portfolios and what you can expect to see in the portfolios. But if you have any question about this or anything else, just let us know. Thanks.